Hello. Happy what are we? Monday now. I'm losing track of the days. So here today we're with Margot and Betty and Ken, and we're going to talk about creative ways to fund your perfect retirement living. Margot Aerosmith is the creator of the course and our resident expert on this. But one of the things that we're going to talk about today is many of the options for retirement are quite expensive. They could be sometimes hundreds of thousands of dollars when it comes down, and tens of thousands of dollars, $10,000 a month. And sometimes people just don't have that money sitting around. So we're looking at creative ways of funding that. And one of the ways we're looking at is reverse mortgage and other creative ways of using money. So, Margot, maybe you can introduce yourself and introduce Ken, and we'll get the party rolling.
Okay, I'm Margot Aerosmith. As Greg said, I'm the creator of the course. I also wrote "You Can Keep Your Parents Home," which is another option that people have, is living it with families. But today I'm very excited. Several years ago, remember back in the days before COVID, when networking groups actually met each other face to face. Well, I have known Ken, oh gosh, maybe 10 years now. And from the first time I met him, I have been so impressed with him. He's going to tell you more about what he does, but basically he does what is known as reverse mortgages. I think he has a different name for it. I'm not sure. But what I was struck with the most is he not only is this wealth of knowledge. I've never met anybody or talked to anybody who knows more about this subject. And at the same time, he's just overflowing with integrity, which is what you want. When you're talking about your house and what you're going to do with it, and having money for retirement, you want somebody with, if you can find somebody with half the integrity Ken has, you're going to be doing good. So I'm going to shut up now, and I'm going to introduce Ken Updegrave. And Ken, please tell us what you do and what people should and shouldn't do.
So I'm Ken Updegrave, and I'm with Fairway Independent Mortgage. And what I do is work with folks that are in the older demographic that are looking to try and stay in their home for as long as possible, but also trying to figure out how to monetize what is oftentimes their largest asset. Lots of times the home equity that they have will exceed what they have in other types of retirement savings. And so, people find options where they really need to monetize that home equity. And what we do is work with them and try and help them structure a plan that enables them to use that home equity, but at the same time, be able to continue living in the home for as long as they possibly can. And we do work with a number of different products, but primarily the product that we work with here in the United States is what's normally been termed a reverse mortgage, but the technical term for it is a home equity conversion mortgage and it's an FHA insured product that the Department of Housing and Urban Development has had in place for 30 plus years now. And it's undergone quite a number of changes structurally during those 30 years, but basically it enables you to tap into that home equity and still be able to stay in the home and live in it as long as you possibly can, which is for most people one of the preferred options that they have.
So Ken, if I were to call you up, or if Betty were to call you up, or Greg, how would the process go? What happens? We call you up. I'm interested. What do you do? What happens?
Well, when I get a phone call from somebody that has interest in it, my first conversation and question with them is, trying to figure out what problem they're trying to solve, because nobody wakes up in the morning and decides to call somebody just because they think they want to get a reverse mortgage. They've got something that's going on in their life that is precipitating them making that phone call and trying to figure out how to use their home equity as part of the solution to that problem. So identifying what the problem is, figuring out whether this is a viable solution for them, and then trying to help structure the solution to best meet their needs is what I'm trying to determine in an initial phone call. And, that initial phone call, typically can take 30 minutes to an hour, maybe even longer, depending upon the person's or couple's situation. But ultimately, you have to figure out what problem they're trying to solve so that you can help them solve that problem. Because what we're trying to do is put them in a position where they can have a sustainable solution to whatever problem that they are facing, and not sell a product but sell a solution for them.
Very. I would bet, and I've never, we've all seen these advertisements on TV with a celebrity who I'm sure a lovely person, but who says, "Oh, this is wonderful. This is the answer to your problems." It seems like those companies, to them, the problem is, how do you get a reverse mortgage? You're saying, no, first we want to find out why you're even calling. That's the place to start.
Yeah, that's the place to start. I mean, you can't help somebody solve a problem or even identify whether the reverse mortgage is a viable solution for them until you really understand what their problem is. And not to knock our competition, but when you're dealing with somebody that's working in a call center, they're going to basically just take names and numbers and dial until they get a viable prospect on the line. And they're trying to do similar things, but I think largely a lot of times they do not take the time to figure out what that person's problems are and what they're trying to solve, because they're not trying to just take out a mortgage to take out a mortgage. I mean, historically, people have wanted to have their mortgage paid off in retirement, and that's been a good solution. But the fact of the matter is, now about 50% of the people that are entering retirement in the United States still have an existing mortgage. And, their goals and their objectives at that stage of life are completely different than a first-time home buyer or a move-up home buyer that are trying to, either build equity in a property and have a place to live at the same time, or buy a larger property that meets their family's needs as well. At the stage of life that the people that I'm dealing with, they're trying to figure out solutions that typically revolve around two things. One, either trying to create more cash flow for themselves, or trying to create some liquidity out of an asset that has typically been illiquid for most people. And, we have the means to do that for a lot of people. It's not an ideal solution for everybody, but for quite a number of people that are entering in or are in retirement, we can help them provide a solution that either increases their cash flow that they have available to spend on living, or create some liquidity for them to be in a more comfortable state of mind as far as, are we going to be able to do the things that we want to do in retirement? And is our retirement lifestyle going to be the type of retirement lifestyle that we kind of hoped and dreamed
Can
for?
you give us a couple examples of somebody of a specific problem where a reverse mortgage can help or solve it, and how that works, how it gets solved?
Yeah, I'll give you a couple of examples of it. And, the typical, I think when people think about reverse mortgages, they typically are thinking about somebody that is house rich and cash poor, and they're trying to figure out how to monetize that home equity to be able to provide the cash flow that they need. And that's certainly a segment of the customer base that we work with, but it's not the only segment of the customer base. It's become much more of a financial planning tool for a lot of folks in entering in or in retirement. Uh, and it gives them an opportunity to perhaps do some things that overall will create better outcomes for them, either currently or in the future. And by saying that, I mean, if they've got uh, a fair amount of assets, one of the most dangerous things for people that have assets in retirement is, what happens if the stock market goes down, or what happens if the bond market changes and their bond valuations aren't what they were going forward. That creates problems for people that not only from a cash flow standpoint, but from an emotional standpoint. If you wake up and you had a $500,000 portfolio yesterday and the market changes and now you've only got a $300,000 portfolio, mentally that's very taxing to you. But some of the solutions that we look at is, going ahead when you're relatively young in retirement and putting this thing in place where you have the ability to draw out of the home equity asset instead of having to draw out of retirement assets that might be in other types of investments. Because
so that if the market starts to go back up, you haven't taken all your money out in panic.
Correct. So, there's strategies that we work with financial planners where they might take the housing asset, put a reverse mortgage on it with a line of credit on it, not actually utilize it initially, but have it in place so that if the market goes down, their customers are that they're working with are not having to sell their assets at a depressed value. They give them a chance to have the market rebound where they can draw funds out of the home equity instead of taking money out of the market, and give them an opportunity to have what's called a non-correlated asset to draw from instead of drawing from their portfolio in a down market.
Goes back up, then they haven't sacrificed that money. I would think also something kind of more concrete would be if someone, which many people want to stay in their homes, but they don't have a downstairs bathroom and they're worried that when they're 85 years old, how are they going to, that taking money out of the equity of the house to build a downstairs bathroom with a walk-in shower for safety purposes, like sort of helping yourself stay in the home.
Absolutely. We definitely deal with folks that are wanting to, I guess, put their home in a place where it's more sustainable for aging in place versus where it was originally. The other thing that we are dealing with a lot these days are folks that are either downsizing, and really what we find right now is they don't really downsize, they just right size. They end up having about the same amount of square footage as what they might have had previously, but it's configured square footage that's more suitable for somebody to be able to age in place. And in that particular case, we can utilize that and take the funds that they've got in equity from the sale of a previous residence and utilize part of that in the purchase of the new home, and gives them the opportunity to take some of that equity and put it into other assets as well. So, they are able to accomplish the goal of moving to a place that meets their needs better, but not tying up all their equity in the bricks and mortar of that house to be able to have that equity to utilize in other manner going forward.
Mm-hmm.
I have a comment about that. With the right sizing, last week we talked about the Golden Girls option, basically having people share a housing one space. So kind of related to that, what you said is by right sizing is maybe doing some modifications on their existing home so that they can have live-in help or make it more appropriate to where they are physically. Is that the kind of thing you're looking at?
Yeah, absolutely. I mean, I work with people that have moved into a number of different 55 plus type communities, and oftentimes they'll build it out to meet their needs on the first floor, but they might have the ability to add some second floor square footage, and they'll add some second floor square footage to either give a family member or a caregiver a place to stay while they're staying there, and helping them be able to remain in that house as long as possible.
Okay.
And kind of to tack on, going back to your Golden Girls comment, the reverse mortgage could actually play into place with that. You don't have to necessarily be related, but if all of them are 62 or older, they could all be a portion of a part of the reverse mortgage. So, if you had three sisters or three close friends that wanted to live together, we could do the reverse mortgage with all three of them in there. And as long as one of them is staying in the house, they're not going to ever have to worry about making a monthly mortgage payment on it. The only thing that they need to make sure that they were paying is their property taxes and homeowners insurance and any kind of HOA dues.
I like that, because one of the problems that can develop with the Golden Girl situation is if one person owns the house, it's kind of like that becomes like the landlord. But if what you just suggested would make it more equitable and might eliminate some of those problems. I'm not necessarily, but it's a possibility for doing that because they all have a stake in the house.
Yeah, I think that is definitely true. There are some things that need to be talked about if you're going into a situation like that, about how the remaining equity gets divvied up and how things would play out in the end. But I think it can be a viable solution for folks that are looking to do that. And, if you've got somebody like that you've got a trio of people that come to the table and they've got each of them has a little bit of assets to put into getting into that Golden Girl situation, they can end up buying it without having to pay the full price for a home and still not have any kind of monthly mortgage payment.
What happens if whether you do it with through Golden Girls or whether you just all by myself, I get a reverse mortgage on my house and I don't ever have to pay it back, right? As long as I'm living in it. What happens when either I die or move out for whatever reason? What happens?
So it's very similar in either case. You're not required to make a payment while you're living in the house. You could make payments. So going back to the situation where we were talking about, if the market went down, you used your home equity to fund living and allowed the market to go back up. At that point, you could also, when the market goes back up, you could sell some assets and pay down that reverse mortgage so that you're not having to accrue interest on that whole amount. But in the particular case that you're asking about, if you pass away, the loan becomes due and payable. Your heirs are responsible for paying it back. Now, there's no recourse, which means that the only thing that can be used to satisfy the loan is the value of the house. But if there's equity remaining in the house, the heirs are going to want to either sell it or utilize that equity. So they have a period of 6 months plus 2 90-day extensions. So essentially a year to be able to sell the property and take out any remaining equity. If you were to go out of the home for care or move into some other type of living arrangements, essentially it's still considered your primary residence until you've been out of the house for 12 months. So if you're out of the house for medical necessity for 12 months, then it becomes due and payable, and you've got a 6-month window to be able to sell it or refinance and pay it back. So sometimes if it's a family home, the heirs may want to refinance and pay off the existing balance on the mortgage and then keep the home. But for the vast majority of them, the home is just another asset that they have to liquidate. So they're going to sell it and pay it off the mortgage and then take out any remaining equity and distribute it to the heirs.
Basically, though, your reverse mortgage is also reversible. Like I said, you can make payments while you have a reverse mortgage. It's that you don't have to.
Correct. I just did one for a customer of mine that lives in a high-rise condo up in Northern Virginia, and her goal was she wasn't comfortable making the amount of payment that she was going to need to be able to make on a monthly basis, but she still wanted to make payments. So instead of making a $2,000 a month payment, she's going to make a $700 a month payment. It'll help defer the growth of the interest on her loan going forward, and then it'll enable her to have more assets to leave to her heirs if she needs it. But the beautiful thing about that is every dollar that she pays goes into a line of credit that she's able to draw out and use in the future.
Wow. And this, by the way, is if for no other reason, really highlights why it's so important to have someone like you as opposed to some call center and then somebody calls you back and says, sign on the dotted line, that somebody who really knows and really will spend hours, it sounds like, potentially talking to potential customers to find out what's going to be best for them.
Yeah, absolutely. I mean, when we're dealing with the type of customer that we're dealing with, they are very deliberative in their process of doing that, which I think is very important because you're making a decision about a very large asset and how you're going to position it to be able to do the things that you want to in your life. But you need to understand how the product works, what the downsides are, what the advantages are to it, and really, understand what your options are for taking out money out of the home equity so that you can utilize it best currently, but also for the future if that's your plan, because there are options. You can take money out of a reverse mortgage in three different ways. And typically my customers are going to take it out in at least two, if not all three different ways. So
Oh,
the three ways that you can take money out is you can take it out in a lump sum. So a lot of people are going to take out a lump sum to pay off an existing mortgage that they have that they don't want to continue making payments on. You can set it up to receive a monthly payment of either over your entire lifespan or over a certain period of time. So if you know you have some needs to meet for the next 5 years and you need to have $1,000 a month for the next 5 years to do that, we can set it up that way. But in my opinion, the Swiss Army knife of the reverse mortgage product is the line of credit, because the line of credit really gives you a lot of flexibility as far as being able to utilize it in the future. So most of the time when I'm dealing with a customer, they are paying off an existing mortgage. So they'll take in some lump sum to pay it off. And then they're either setting up a monthly payment or they're setting up a line of credit. And in most cases, they're setting up a line of credit that they can utilize in the future to draw from as they have needs.
are there bad reasons or reasons that concern you, that people say, when you have these talks with them, that they want to do the reverse mortgage? What concerns you?
So I think that the primary concern that I have when I'm initially having a conversation with somebody and trying to determine if this is a good fit for them or not is figuring out how long that they expect to stay in the house. Obviously, you don't know day to day what's going to happen, what's going to change in your life, and that those expectations might not be met. But if I have a customer call up and they tell me that they're going to plan on moving in the next year or two, I'm going to talk to them and probably propose to them that if they need to access equity, uh, and it's going to be for a short-term period of time, like a year or two, that a traditional home equity line of credit that they would get through any other bank on it might be a better solution if they qualify for that. And the reason why I say that is because the closing costs on these are higher than what it is for a traditional mortgage, because it is an FHA insured product. FHA has a mortgage insurance component on it that it adds to the cost of doing the loan. So really the break even point for somebody being able to do it and make the closing costs make sense is generally going to be somewhere in the 3 to 5 year plan. So if somebody calls me up and tells me their expectations are that they're not going to be in that house in 3 years, then this probably isn't going to be a good solution to figuring out how to solve their problem.
And again, it's important to talk with someone who will give them that information.
Yeah, but I mean, the reverse mortgage product has a negative connotation for a lot of people, and the worst thing we can do is put somebody in it that is not appropriate for their situation. It's all, I've said this for years, even when I was doing traditional mortgages back when the housing market crashed in 2007 and 8, and there was a lot of blame about mortgage products out there. What I'll always say about mortgage products is the product is a product. It's not necessarily a bad product if it meets the needs for somebody else, but it needs to be a sustainable product for whoever you're actually putting that person in a product. Like, just to kind of go to that example, back in the 2007-8 range, the product that really got a bad name on it was the pay option arm, which gave customers the flexibility to pay less money in a month than what they would typically owe in interest if they wanted to do that. And that product was not the right product for a lot of people. But if you had seasonal income, or your income was variable and you had the ability to pay a larger payment at certain times of the year, and a smaller payment at certain times of the year, like perhaps a real estate professional where a lot of their business is in 6 or 8 months during the year, that product gave them a lot of flexibility. The problem is that it got sold to a lot of people that really shouldn't have been in that product. So the worst thing we can do as an industry is sell this product to somebody where it's not helping them be a sustainable solution for them.
Right. And again, not a problem with calling a call center where they get thousands of calls a day, and they certainly aren't going to have time to sit down and really talk with people about what their situation is, to get back to what you said, what their problem is that they're trying to solve, or anything like that. And they're more likely to end up in something that is not the right product for them.
Or even if it's the right product, sometimes they end up in a solution where they are not utilizing the product in the best fashion as well, because you've got a lot of options with this. I mean, I know when I first started in the reverse mortgage business in 2010, a lot of the products a lot of the people that were taking out reverse mortgages at the time were taking out all the money at one time, whether they needed it or not. And there's a huge disadvantage to that, because you're accruing interest on that whole balance. And if you don't need that money, you've got to figure out, where can I invest that money to give me enough return that I'm able to offset the interest that's accruing on the loan balance. So those people would have been much better off taking out the reverse for whatever they needed to pay off, and then leaving the rest of it in a line of credit for future use, because they're not accruing interest on the money that's in the line of credit. In fact, that line of credit is growing over time for them to be able to utilize in the future.
And they've only paid the one closing cost. Just when you first get it, you pay the closing costs. It's not like if you have a line of credit and you take money out later, you don't have to pay closing costs again. Am I reading that correctly?
Yeah, that's correct. And I think I noticed a very distinct shift in the way financial planners and financial advisors looked at this product after the housing crash of 2007 and 8, because financial advisors typically had told people, go set up a home equity line of credit, and you'll have that home equity line of credit to utilize if we need to tap into your home equity. And that worked really well until the housing market started going crazy and the housing values went down. And what we saw from that housing market crash was the banks that were lending on these home equity lines of credit were either freezing or canceling the home equity line of credit right at the time when people really needed it the most to be able to meet their needs, because they might have lost a job, or they may be in a position where they needed to tap into that home equity and it wasn't available for them. With the reverse mortgage, if you're eligible to take out a reverse mortgage, and you take out a reverse mortgage and leave it in that line of credit, you have the ability to access that line of credit in the future, and that's guaranteed by FHA as the insurer of the loan. In fact, when we do these loans, they are a little bit different than traditional mortgages, in that they have 2 notes and 2 mortgages, or 2 deeds of trust, depending upon the state that you're in, that are attached to it. One of them is to us as the lender, and then the second one is to FHA. And that second note and second mortgage to FHA enables FHA to step in and fulfill any obligations due to the borrower if the servicer were to ever to go out of business. And sometimes that happens that the servicer goes out of business.
Oh.
Basically, that second note and second mortgage enables FHA to step right in and be the backup if the servicer ever goes out of business, so that the customer who's in need of having those funds isn't trying to figure out where they're going to get that money from if the servicer were to go out of business.
Right. How old do you have to be? And if you're disabled, is it a different age?
So if you're a married couple, at least one of you has to be 62. If it's a single individual, they have to be 62. If you're a married couple and one of you is 62 and the other one's 60, we can do that. There's some special provisions on that because that second spouse that's not 62 is not an eligible borrower. So what we call that is the loan with a non-borrowing spouse on it. That non-borrowing spouse is able to be on the loan. We have to use their age in working through the calculations. So it reduces the amount that they have available to them. And there's some downsides to that too, because with a non-borrowing spouse, they are able, as long as they do the things that are necessary, if the spouse that is of age passes away, they are able to continue living in the house for as long as they are able to. They don't have the ability to fulfill some of the things that are available if the spouse that was of age when the loan's taken out
but again,
passes away first.
Really emphasizing the benefit of having someone, an individual, not a call center, an individual who sits down with you, who talks with you about your situation and knows all the products. I know you work in North Carolina. I learned today that you also do Virginia. Are you, if someone, and of course, you, as wonderful as you are, you can't do the whole country. So if someone's in California or British Columbia, how do they find their own Ken Updegrave?
Well, the company I work with is a nationwide company. So I've got lenders that are available in all the states that we're licensed in. And I'm pretty sure that we're licensed in at least 49, if not all 50 states.
Okay.
So if somebody has an interest in doing it, they can reach out to me. I can put them in contact with a reverse mortgage lender that is licensed in their particular states. Personally, I'm licensed in Virginia down through Florida, and then also in Tennessee. So I'm licensed in 6 states, but that's all the states that I really do. But I do have lending partners that I can refer them to that are qualified and can work through the process the same way I do.
The same way you do. And to me, that's extremely important. Any other questions, folks? Ken really gave us a very good picture of this. So I really appreciate your time today. Betty, did you have something?
Well, I have just been listening and learning. There were a lot of things that Ken brought out that I didn't know about reverse mortgages. And so it's always good to, understand more about what's available in terms of financial products. And, I agree with you, Margot, that having someone that actually listens to you is key in anything that you're going to do in planning any kind of enterprise, but particularly the big enterprise of your own life.
Yes.
Betty, what if you don't mind me asking, what were some of the takeaways that you learned that you were not aware of before our conversation?
Well, I liked what you said about the 3 different options for taking funds once a reverse mortgage has taken place, and the fact of it being really, you could look at it as being a line of credit, because if you only take what you need and then you have the ability to access other funds, it gives a different set of options for financial enterprises of any kind. I didn't realize that was the case. I kind of thought it was a lump sum option, and realizing that there's other ways to look at it was instructive. It was good to know that.
Yeah, I think that that's one of the most beneficial things, and the fact that that line of credit increases over time to give you the benefit of not utilizing it immediately, uh, e- even strengthens the case for you to take out as much in the line of credit as you possibly can versus how much you're taking out for immediate usage.
Yeah. Yeah, yeah. It's a creative way for people to look at their situation, particularly certain kinds of people. And I'm sure you know much more about that than I would. You know, for certain people, it's the most sensible option. You know, and for other people, it's like, well, you know, I have this in my back pocket, I could use it. And the other part is that knowing that it's unlike the previous products that were offered as home equity, and all the people who lost that ability during the housing crash, this option being insured by the federal government makes it, you know, and that they will, you know, show up if the company fails in some way is an important piece of security for people to know about.
And FHA charges a premium for that. That's part of the what the mortgage insurance goes to. But to clarify on the mortgage insurance too, most people when they think about mortgage insurance, they think about it being for the benefit of the lender, and that that somebody's going to put down a relatively low down payment, and they want to make sure that if something goes wrong, that the lender's able to recoup the funds that they've distributed for for that loan. In this particular case, the mortgage insurance does that, but in addition to that, it's the reason why this loan can be considered a non-recourse loan, which means that the only thing that they can use to satisfy it is the value of the house. So people that have other assets, they can't go against those other assets to satisfy the loan. If the home value is less than what they're able to sell the property for, and at the end of the loan, the mortgage insurance kicks in to make the lender whole, but the customer never has to bring any additional, or the heirs of the customer never have to bring any additional cash to satisfy the loan. So I think that's of huge value. And going back to Margaret's question, she asked about Greg and who he could find in British Columbia. I know that that in Canada there is a reverse mortgage product available. I just don't have a whole lot of knowledge of how that product works and how it's different than the product that's available in the U.S.
But you do, even in Canada, it's still wise to make sure that you have a person that you are working with who will talk with you and find out what's going on. That working personally is very important.
Right, and I would say that if you're in an area where you don't have somebody that that is going to do the types of things that we do when we're meeting with our customers and figuring it out, that it would probably be to your advantage to find somebody that is you're working with, either as perhaps an elder law attorney or a financial planner, or somebody that is working in the senior space, because they probably know somebody that works in a similar manner to what I do, and they can probably refer you to that person to be able to give you the necessary um, questioning to be able to figure out what you're trying to solve and be able to solve that problem for you.
Okay, great. Wow, this has been wonderful, Ken. I'm so happy that you were graced our show today. It was really, as Betty said, it was just very helpful.
Thanks. I've enjoyed talking with you guys, and if I've brought a little bit of knowledge to a few other people, that's a great thing. Because I think it's important that folks know that this product isn't correct for everybody, but it can be a real game changer for a lot of people that have significant amounts of wealth in their house. And it can be a game changer for people that are looking for solutions to problems that they might have in the future that aren't easy to necessarily plan for. Like, take for example, somebody in their early to mid 60s that has a lot of home equity, and they're trying to figure out how to plan for and pay for long-term care. long-term care insurance is really expensive when you get to your 60s, even if you can qualify to get it. But if you've got a lot of home equity available that you weren't planning on having to utilize, putting that into a line of credit where it's available for you to utilize in the future can oftentimes offset some of the need for feeling like you need to have a long-term care policy.
Wow. And easier to get at, because I've known people who've had long-term care insurance where it becomes a full-time job trying to get the actual money that you know, from the insurance company.
Correct.
So that would kind of eliminate that. That's I never thought about that. That's a great idea.
Right. I mean, I've seen folks that are in their early to mid 60s and as a couple looking at getting long-term care, and it's $8,000 to $12,000 a year for them to be able to pay for long-term care for each of them. If they've got a lot of home equity, if they own their house free and clear, we could probably set up a reverse mortgage at about the cost for what it would be for 1 year of that, and put it in a line of credit that's building over time for them to utilize in the future.
Exactly.
So there's some downsides to that, and you really need to think through it and make sure that it's going to meet your needs. But it does. But like you just said, long-term care has its downsides too. You have to navigate that process, and a lot of times when you're in need of long-term care, you're not necessarily in the best mental state or best physical state to be able to have to fight to get your benefits there. So
I had a client who was in his 70s when he got Parkinson's, and it accelerated very rapidly. I mean, within 5 years he was totally incapacitated and then died. But his wife literally spent hours and hours every week on the phone trying to get the money for the nursing care that he needed. I mean, it was a full-time job for her practically. So that would have actually solved something. So that's good to know. Thank you, Ken.
Yep. Thanks for having me.
Yeah, thanks for coming, Ken. This is absolutely fabulous information. And for a future broadcast, we're going to talk about using some of the instruments and the things that you did in a sort of a family trust context or a larger thing. Some of your comments about the Golden Girls, where it's kind of pooling the assets of the people living in the property, and sort of a family trust, perpetual trust is sort of like a bigger kind of thing. And it's possible to set it up so that it's not just your immediate family, it could be future generations as something for planning for future generations. And all of it, as you say, there are a lot of different considerations, a lot of different things to consider. Not everybody needs something of a different solution, but the more knowledge is power, the more options that people know about, the better they can be. So thank you very much for joining us today. It was absolutely enlightening and really appreciate your experience and your insights into all of this.
Like I said, thanks again for having me. I think it's important for people to understand what's available and at least be able to make educated decisions about what works without necessarily succumbing to the fear marketing about what products might be bad or what products might be good. There's really no, in my opinion, they're products. They're not good or bad. They're always going to be whether they're suitable for you or not.
Yeah. Right. The right fit, appropriate for the person, for their situation and where they want to go.
Correct.
Okay. Well, thank you very much. Any other last comments before we carry on with our day?
No. Thank you, Ken. I appreciate it all. It was great.
Thanks. Nice to meet each of you. And thanks, Margot, for the invitation.
Yeah.
Okay. Thank you. Bye.
Take care.